See, the market is looking at various factors. While the GDP for the first quarter was way down at minus 23.9, and it witnesses a sharp rebound. I mean, it's still negative, but it was at minus 7.5. Now that sent a positive signal. But before that, if you see, the market started going up from September onwards, September, October, because of various data points that started coming in. See, toll collections were good. They reached February numbers. Diesel demand was there. Then GST e-way bill number, PMI manufacturing, auto sales, both passenger vehicles and two-wheelers. They all almost reached their pre-COVID levels, September, October, and also. So that sent a positive signal in the market. And in November, then there were additional factors. US elections results came in, so there was more clarity on and increasingly it also became clear that Trump was going to accept Biden's victory. So then November 9th, you saw Pfizer announcing the first vaccine, and then subsequently 3 more contenders came and announced that. That all has in fact led to a sharp rebound. I mean, it's starting from September, then going into November. Also, what you must understand that the market has largely been driven by stimulus, the huge liquidity flow in the market. I mean, that has been there to support the economy. Countries across the world, they announced stimulus measures and fiscal packages to support their economies, and that led to huge money in the market. And also there are limited sort of avenues where one can invest. On the debt front, it is low debt yield there. Real estate and all is down, and no one knows. I mean, so there was the equities were big beneficiaries of that also. And the US elections means that once the results were out, now when Mr. Biden will take charge, there are hopes that there will be a fresh stimulus. So there will be more liquidity flow in the market. So and as I said, now coming to GDP factor, market is looking at FY22 numbers, and the sharp rebound in Q2 of FY21 only shows that the recovery is improving. However, there are some negatives there. If there's a second, third wave of COVID there, and if the vaccine's efficacy or if there is any issue on that front, then there may be a slight concern. But otherwise, things are looking fine. Even RBI also revised its GDP estimates number for Q3, Q4. It is in the positive now. They have estimated, even though for the whole year it will still be negative. But so these are the things which are leading to the sharp rebound. And as of now, it is a balance that is more towards the FPIs, because the money that is coming in is far more than the profit booking that is happening. DIIs in the last 8 months have sold around 90,000 crores, but FPIs have pumped in 108,000 crore. So the money that is coming in and getting invested is far more, which is leading to rise in markets. There is profit booking happening because domestic investors feel that we have reached the markets are trading at all-time highs, so they are they are booking their profits. Last month, in fact, mutual funds, equity schemes saw redemptions net outflow of 12,900 crore, which is the highest ever in any month till date. So there is profit booking happening. But as far as bubble is concerned, I would not think there is a bubble. A bubble happens when you see few stocks witnessing huge growth and they are only riding. Then there's a higher chance of crash, because when they are extremely high value, then they go for a decline. What we are seeing now, it's a very broad-based rally currently. While the Sensex in the last 8 months has risen by around 55%, the mid and small caps have grown by 66 and over 75% respectively. So mid caps and small caps have also grown. So there is a broader rally. It's not that only few stocks are rising. Initially it was few stocks, but it has broad-based in a big manner. So I would not say a bubble. There is a concern on valuation front because obviously GDP numbers and all do not kind of support that. But markets trade on future earnings and future growth, and they see that yes, if a vaccine comes in, there will be normalization in the economy, and we all will start living our lives as in the past, and companies will start witnessing revenue and profit growth going forward. The thing with the investment is that yes, we have seen a huge rush of retail inflows going for direct equity investment. The CDSL investor account numbers tell the story all by themselves. Now, for mutual fund investors or for retail investors, I would say you should not look at peaks and get scared of it. This happened when the Sensex was at 10,000. Everybody thought, oh, this is so high a level. Should we invest now? Then when it reached 20,000, there was the same concern. It reached 30,000, same concern. Now we are at 45, 46,000 level. There is the same concern. Should we enter now? But every time, be it in 10,000, 20,000, 30,000, we have scaled and we have come to 45,000, 46,000 now. This is not the end of the peak for markets. If you are looking for short-term gains, and if you think that the gains of the last 3 months, 2 months, 3 months, or 8 months, you will get the same return in the next 1 year, then you should not get into the market, because it was a different scenario altogether. The market corrected hugely because of COVID, and we are coming out of it. So the markets have grown on that front. Investors should also, at this point in time, one should not go for lump sum investment, because yes, valuations are high. If you invest huge sums of money at this level, because markets go through their crest and trough, so we may very well see a decline from here for say another 8-10%. So you should go for monthly disciplined investments in good mutual fund schemes. As far as retail investors are concerned, if you want to go for direct equity investment, pick up stocks, be very careful at this point in time, because some stocks are trading at very high levels on valuation front. Pick good fundamentally strong companies which have done well during COVID times, because if they did well during COVID times, there's a far higher chance of they're doing well going forward too. So pick those companies and fundamentally strong ones which are at reasonable valuation levels.